Hi everyone and welcome to the FAMAS live webinar. My name is Stephen and I will be the moderator of today's session. Before we get started, I would like to take a few minutes to go through some practical details with you. Please note that you're all welcome to join the discussion at any time by Twitter using the hashtag FAMASRisk. And we really want to hear from you all along this webinar, so don't hesitate to send your questions, your comments, challenge our ideas using the chat box on the bottom left of your GoToWebinar player. We will also have a few polling questions so that you can interact directly with our speakers, and they will pop up right on your screen. So at this point, I would like to introduce the topic of today and our speakers. So today's webinar is dedicated to the future of captive insurance companies in Europe. According to the last FAMAS European Risk Manager survey, we see that the number of companies is stable over the last years, around 37% last year, and many expect to use them more. So it really shows that captive is definitely a risk management tool for large companies. And we will see also for the public sector. Its advantages are recognized, and it has allowed the captives to overcome all the new requirements coming from Solvency II and the OECD BEPS recommendations. So with our speakers, we will discuss the unique features of captive and what makes it an undisputed part of the risk manager toolbox. And we will also touch upon the regulatory dimension, as captives are among the smallest insurance companies regulated under Solvency II. So to this end, I have three distinguished guests, Anna Teresa Muntinho, Laurent Newell, and Annika Forsgren. Annika, you have a long experience of industrial and commercial insurance business from two of the major insurers in Sweden, If and Trygg-Hansa. During the last 30 years, you have been working with risk management, risk engineering, claims handling, underwriting, and captive management in different positions, both as specialist and as manager. Since 2011, Annika, you are the CEO of the insurance captive of the city of Gothenburg. Welcome, Annika.
Thank you.
Anna, you are the head of supervisory processes department of EIOPA, the European Insurance and Occupational Pensions Authority. You're responsible for EIOPA's activities related to supervisory review process under Solvency II, data and business intelligence tools, and the operational methodology and monthly production of the Solvency II technical information. Prior to joining EIOPA in 2012, you have been working for 15 years in the Insurance and Pension Funds Portuguese Supervisory Authority. And during this time, you've been involved in the development of Solvency II since its beginning. Welcome, Anna.
Thank you very much.
Laurent, you are the General Manager Corporate Risk and Insurance for ArcelorMittal. You lead the worldwide insurance team and ArcelorMittal's global insurable risk management and financing strategy, including captive reinsurance and insurance and in-house brokerage operations. You are also a member of FAMAS board, responsible for the topic captive. Welcome, Laurent.
Thank you.
So before I give the floor to our speakers, I would like to ask questions to the audience in order to better know for our speakers who we have in this webinar. So as you can see, there is a question appearing on your screen, and we would like to know if you are a captive user. So you can select the correct answer. Okay, we still leave a couple of seconds for you to reply. And so the response will come, the results. Okay, so today we have 51% of the participants in the webinar who are users of a captive, 45% who are not using a captive and don't have a captive, and 4% who are planning to have a captive. So we see that people are eager to hear about the latest development in the captive world and also to understand why captive are used and how they maintain compliance. So Annika, we are very interested in hearing your experience in the public sector and also to know more why a city such as Gothenburg has decided to have a captive. Can you tell us more about it?
Of course, thank you. And I will start this presentation with giving you a short summary about the city of Gothenburg and also some words of our captive of the city called Göta Lejon. In the end, I want to give you some reflections on the impact of Solvency II to our captive. Please, now that we have the right slide. Yes, the city of Gothenburg is an organization comprised of administrations and companies. It has a total turnover about 34 billion Swedish crowns, and we have 564 inhabitants or residents in our city. But in the region, there is about 1 million inhabitants. The municipality of Gothenburg also have an interest in 63 companies, of which 46 are 100% owned by the city. Next slide, please. The city of Gothenburg's municipal organization is quite a traditional one for the Swedish municipality. We have these 10 city district committees. We have administrations for education, land and housing, leisure, technical promotion, environment, culture, transport, and other committees. Quite traditional Swedish municipality. Next, please. Next slide, please. Yes, the municipality owns several companies. The city of Gothenburg has both direct and indirect interest in a large number of companies, which provide everything from apartments to culture experiences. Some of the companies are 100% owned, others are partly owned. We have a holding company, the group company, Göteborg Stadshus AB, that is the formal owner of all the companies. For example, the city owns the port of Gothenburg, the Nordic area biggest harbor. We also own a big energy company. The city also owns the biggest housing company in Sweden. And to add that we also own an amusement park, it's Liseberg. So the city owns, the group is quite verified with both committees and a lot of different companies. So next slide, please. So that means that the city has to handle a lot of complex risks, and they also have big assets to handle. So Göta Lejon was established in 1991. And it's a direct captive of the city. And our mission is to provide insurance solutions, claims management, and risk management support to the city of Gothenburg operations. We have a yearly premium income of 127 million Swedish crown, and our total sum insured is 268 billion Swedish crowns. We are also buying a reinsurance in the international market, about 40 million Swedish crowns per year. And Göta Lejon has today 13 employees working with risk management issues and insurance. Next slide, please. We have a long history, 28 years, but I just want to point out some years. 2013, an insurance policy was decided by the City Council, and that led to an expansion of our captive when several of our big companies was incorporated in the captive. And at that year, the TSI went from 70 billion Swedish crowns to 268 billion crowns. And also want to point out 2015, because at that year we liquidated our reinsurance captive in Luxembourg, mainly due to the implementation of the Solvency II regulations. Next slide, please. Why a captive? As you understand, it's just classical reasons, such it was hard to find insurer to insure our schools and preschools, because we had and we have also today problems with arsons at schools and preschools. There was and is a big need of loss prevention actions in the city. We also had the possibility to build up the contingency reserve through owning a captive. The resources we are able to return resources for loss prevention to the administrations, and we also can handle complex risks and interdependencies. We have a lot of interdependency in the cities. It enables us to have a holistic view on insurance solutions for the city of Gothenburg. And to conclude this, it's a classical captive reason that we have the possibility, by owning a captive, we have the possibility to manage our risks in a cost-efficient way. And you see there is for other insurance companies, all public sector insurance captives, and where we have St. Erik down there, it's the city of Stockholm's captive, and they have all been established with the same reasons as Göta Lejon, and they nearly have the same mission as Göta Lejon. Next slide, please. Yes, I have been working with how to implement Solvency II since 2011. And I want to point out some of the main impact areas concerning Göta Lejon and also share some reflection with you. One of the main areas that we have to increase our share capital. So we got 100 million Swedish crowns from our owner due to Solvency II. The board must meet higher competence requirements and be fit and proper. And that's a little bit a challenge for us because we have politicians in our board. We have to implement a lot of policies and guidelines. And this is also a challenge because the city itself has a lot of policies and guidelines concerning internal governance, internal control, risk control, etc. So in some areas, we have to have a double function, a double system. Of course, we have a higher cost for control functions. The reporting is very extensive. And we approximate the costs for Solvency II about 3.2 million Swedish crowns per year. So I want to say a reflection is Solvency II applicable to a public sector captive? We have no exposures to consumers, it's just the owner. We have no pension on life insurance. The city of Gothenburg is have a very good financial stability. It's a AA+ rated organization. And we have the taxation right of 600,000 citizens. So I would like to end my presentation with a question. Is the cost of control proportional to the risk? Thank you for listening.
Thank you very much, Annika, and definitely you're raising interesting questions and remarks regarding the application of the public sector to Solvency II and the implementation of the principle of proportionality. So definitely this is a key point and key issues that I'd like to come back a little bit later during the discussion and notably also to hear the views of Hannah on this. But before, I would like to move to Laurent. Laurent, you are working for a large multinational company, ArcelorMittal, and after having heard Annika about the why and the how of creating a captive in a public sector, do you see any similarities, differences for the private sector? What are the main advantages for a large group such as ArcelorMittal to have a captive, basically?
Well, first, I'm afraid I will not add so many interesting points to Annika's presentation because the basics are, I believe, quite the same. Maybe for a multinational, I would emphasize the operational aspect because we have a large geographical footprint, and also maybe that we have a more financial approach, I would say, compared to the public sector, because in a private and listed company, of course, the financial result is one of the main drivers for our operations. So before going to the reason why and how we use a captive, just to give you a bit of background about ArcelorMittal and what we are talking about. So it's a mining company, that the largest one worldwide. So we talk about a company having 76 billion turnover in 2018. We talk about more or less 210,000 people worldwide in more than 60 countries. So you see on the map the orange countries is where we have a presence. So the objective is not to go, of course, into the details and explain you what is ArcelorMittal and where we operate. It's just to give you a feeling about the fact that our insurance operations are truly global and are, of course, focusing on large industrial assets with large exposure in terms of potential claims. And obviously, our captive is a cornerstone of our strategy to manage this, both from a financial and operational perspective. I'm going to try to explain that in a bit more detail. So we can go to the next slide. So to the question, why are we using a captive? We always summarize it in three main dimensions. The first one is what I call the reinsurance basics. So it's really about the technicalities of insurance, about how a cover is structured, how you can leverage reinsurance, how our pricing is calculated for a risk by the insurance market. And you have different, let's say, areas where a captive could be useful to support you in this. And it's, of course, about how you control your insurance pricing, so your insurance budget, how you access the reinsurance sector directly, how you implement your program, and how, of course, if you have large basis, you can already, what I always call, pre-mutualize your risk before going to the insurance market. The second dimension is what we call risk control. So it's about how you can use a captive to improve the risk management and the risk prevention measures in your company by leveraging on the captive as a central tool will help you to collect data about your claims, about the root cause. It will help you to see trends, in the kind of claim you have worldwide or between, business segment in your organization. Because very often the captive, by its central positioning within the group, has very specific access to useful data that you can then link to the prevention department, health and safety, topics for investment, security, and so on. And the third dimension is what I call finance strategy. So it's, of course, I was talking about, we certainly have a more financial approach at the public sector. It's about the financial benefit you can have by using the captive compared to just transferring your risk into the insurance market. So it's about cash flows and the cash flow benefit you can do the captive, because an insurance premium is paid upfront and then an insurance company will sit on the cash until the claims are paid. With a captive, you can recapture a part of that cash and keep it within the group. So it's about cash pooling mechanism. It's about capturing profit. So with a proper insurance or reinsurance tool, of course you can pay claim, but very often if your price is calculated in the proper way, you can capture the technical profit of your risk that would be left to insurance companies if you just transfer it. And it's also a very useful tool in terms of operational efficiency and supporting you in managing global programs. I was talking about our geographical footprint. It's a very useful tool to centralize your underwriting process and also to help you to negotiate with insurance companies once you have the entire group behind you and you use a captive as a negotiation tool to the market. So if we go to the next slide, so you'll see what I call, if you go to the reinsurance basic, I always say there are three basic rules that we should look at. So the first one is about looking at your own risk profile to see where you should position your captive, depending on your size, the size of your risk, your exposure. So if you just look at that graph, on the vertical axis, you have frequency. On the horizontal one, you have impact. And in that typical curve of distribution curve of losses, of course, and it's nothing too fancy. Right? It's just saying that normally you are supposed to have a large amount of very small claims and hopefully a very low amount of very significant claims. So there is no real benefit in transferring to the insurance market your low claim. So what is in the retention and transfer part of the graph, because basically the premium will be the sum of claims plus the overhead and the benefit margin of the insurance company. So this is really where you should position your captive, and the blue arrow is just showing that it has to be done in line with your risk profile, because the right side of the graph is really what you should transfer to the market, meaning the catastrophic, the catastrophic event as the one that could really impact your P&L or your balance sheet by the end of the day, once again, depending on your size and your risk profile. So the risk premium, as I said, asked by the insurance market for very high frequency should tend to be sum of claims. So it leads us to the second rule, which is, how do you optimize your budget? And the kind of, let's call it the philosophical or conceptual view, is really to say, if you look at your claims and if you look at the actual commercial premium, which may be small, I don't know, it's the blue arrow on top, it's not always linked. And of course, it's obvious because it's mutualization. So you also depend on the results of the insurance market. If other companies have big claims, if companies are making losses, the price of insurance could be decorrelated from your own risk profile. So the conceptual view is to say we should always try to use a captive to follow the red arrow, which is going to as close as possible to the pure risk premium to really be financially efficient in the way we finance our risk, meaning we just spread them over the time. And the third rule is that always bear in mind the total cost of risk. So premium is just one side of the equation. So of course, when you try to look at where should I position my captive, how should I optimize my budget, it's also about premium plus, of course, the losses you retain. And this is also a conceptual view showing that, of course, the more you retain, the more the insurance premium is going down. And there is somewhere a balance or the equilibrium between both that show you the minimum cost of risk, meaning that you pay the minimum insurance premium with the right level of retention in your company and normally in your captive. So that's the three basic rules linked to what I call the reinsurance basics. So if we go to the next slide. Yeah, so then it's just a few examples of how we can use a captive and what we do in some of our programs. So the first one is about optimizing operation. It's about using your captive as a centralized underwriting tool to support, the way you manage, as I was saying, worldwide insurance program. So very basic example, but in all countries, you have a subsidiary, you will have a local insurance company issuing a local policy and collecting the premium. And everything will be reinsured to our captive centrally. And then the captive will, of course, retain a part of the risk as a kind of, let's call it a top-up deductible on top of the retention of the local countries. But main importantly, we will, with the captive, go to the reinsurance market to buy the group cover. The only cash out premium or real risk transfer will occur at that level, and we purchase one big cover that will be then accessible to everyone through the channel, but in the other way around, so going down then to the local insurance company and our subsidiaries when and where a claim occurs. So it's really about being operationally efficient, and also it helps us to, let's say, obtain the best quality of cover that we can then cascade in the country. Because you can imagine in some countries, because of the local insurance market, some cover are not accessible or the capacity is not accessible. So our entities would benefit from different level of cover by using the captive. In that way, we ensure that we can implement our insurance standards in all companies. I mean, no matter what is the country or the insurance practices in that country, they can really access the astronomical quality of cover in any country. So if we can go to the next slide. Yeah, so very quickly, another example, very basic once again, is to use a captive in DIC, DIL, so difference in condition, difference in limit. So here the idea is to say that very often in the insurance market, when we want to set up, and what we believe is an optimum insurance cover in terms of quality, we have exposure or risk that here and there are not acceptable to the insurance market. So it's not only putting the captive below the market, the risk transfer, it's also supporting the risk transfer by taking out of the insurance program we would purchase from the market some specific exposure or cover that we would retain 100% in the captive. The next slide. And the last example is a very typical way of using a captive when you are a multinational, is to harmonize the retention level of the group in line with the size of your subsidiaries. So of course you can imagine that all subsidiaries have different size and turnover and also risk bearing capacity, meaning that if we apply the retention of the group, so the international program, to some entities locally, with the claims they could be bankrupt because it's too high for them. So we personalize the deductible to the size of the entities, and we use the captive in the middle to, let's say, make the bridge between the local deductible and the international program to optimize the negotiation power and get the best price and best quality in the international program. So next slide. So we can go to next. That's a wrap up. Two key insights. I have two messages I would like you to remember. That the first one is it's insurance versus financing. My point is that we do not buy insurance, we finance our claim, except for the captive. And the second principle is premiums equal claims. I mean, by the end of a long period of time for industrial companies, the claims will be recovered by the insurance company through premium, once again, except for the cat claims. So it's really about, it's not buying insurance, it's a swap of cash. The captive is more efficient and more cost efficient than the use of traditional risk transfer solution to manage that. And the last slide, I believe. Yes, so if key focus points, the first one is consolidation, IFRS, depending if you are under IFRS or not. So if you have to manage a captive, it's really to clearly understand what are the consolidation impacts on your group in terms of volatility, in terms of exposure. Frictional cost, of course, should be part of it. Running a captive as a cost, and it should be part, if we go back to a few slides before, the total cost of risk, that's part of it. You know, you have the cost of collateral, you have the cost of management, you need some cost to manage your captive, and Solvency II, of course, has increased a bit that cost. It's also about the risk appetite of your company. You need to clearly understand how much you can retain and how you can retain your risk. And cash out versus cash inflow. That's always my point about any cash out saving you make in premium is indeed an additional exposure to you. So it has to be linked to the risk appetite. There is no magic. I mean, you cannot win everywhere. So it's also something that we have to manage carefully, because saving premium is easy, but what is the real exposure behind that when we retain it? And it's linked to other risk, consolidation, risk appetite, and so on. And as a conclusion from my part, if I think about future challenges, because we were supposed to talk about the future of insurance, captive insurance companies, I see three main challenges. The first one is BEPS and other pricing and tax challenges that we see coming. So it's about how you explain the economic rationale of your captive, how you are able to document the pricing of your risk transfer and the arm's length aspect of your risk transfer, to be sure that you have no tax impact and your insurance transactions are seen as genuine insurance transactions. The second challenge is coming is the insurance market cycle. So it seems that the industrial insurance market is hardening. We're starting to harden again. The last hard cycle was 17 years ago. So nobody in the industry, you have a whole generation of underwriters and risk managers, not knowing how we are going to deal with the hard market. And the captive is crucial to deal efficiently with the hard market. So it will be interesting. And the last challenge is, of course, the regulation and Solvency II. So Annika has explained how it impacted the way they manage the captive and the burden. So it's the Solvency II revision and ongoing is for us really something we are looking forward to see the outcome and to see if proportionality may support the captive in a time when they will be more needed maybe than before. So thank you. That's it for my part.
Thank you very much, Laurent. And so we see that you have highlighted as future challenges, so the regulatory environment in which we are living, and notably at European level, the revision of Solvency II. So it gives me a very good transition to our second polling question that I'd like to ask the audience before I give the floor to Anna. So the question is, does your captive benefit from proportionality measures? So for example, in terms of reporting, governance, etc., put in place by your local supervisor in relation with Solvency II. Of course, this question is addressed to those of you who have a captive. And you can see now the question on your screen, which you can answer. Okay, we'll wait a couple of seconds more. And the results are, okay, so the majority does not know, basically, if they benefit from proportionality measures. Then we've got 38% no and 21% yes. So very interesting results. Laurent, based on the work that FAMAS did on this question, Are you surprised by these answers?
Yes and no. Yes, because we know, so if I have to summarize this in 2 minutes, so FIRMA did a kind of a survey with National Association and Marsh and Aon Captive Management. So we have collected data from, and it represents 9 countries and 264 to be precise, captive companies. And we see that you have proportionality measures apply across almost all countries, of course, in different way. So I'm a bit surprised. Maybe we can talk about that later on after Anna's presentation. I'm surprised about the mix of the answers, because it's more or less 1/3, 1/3, 1/3 if you look at this, except for the yes. I would have expected the yes to be a bit higher.
Okay. And Anna, it seems that the implementation of the proportionality principle is patchy across the member states. So does it mean that there is a lot of lip service done by national regulators?
Well, it is true that we have very different applications of proportionality across Europe. We have identified that in our annual report that we do. I'm now focusing more a little bit on reporting, which is the ones also that both of you referred. And even if you go to other areas like governance, it's even more tricky to try to understand. The other problem we have is that it's difficult for us, and we will try to solve that in the future, to streamline the analysis only for the captives, because at an European level, we don't have a clear identification of the captives. It's something we need to solve, definitely. But in general, on the application of proportionality, I'm not surprised. It reveals, in fact, what we see in our reports and in our analysis on the proportionality.
Okay, thank you. So I suggest that we go a little bit deeper with a third polling questions, which is about the proportionality measures applied locally. So which are the proportionality measures that are applied by your local supervisor to captives? So there is a selection, captive requirements, solvency calculation simplification, or in terms of reporting, the frequency, the size of the QRT, RSR, or in terms of governance, or others. Okay, so we will see the results. Okay, so it's split. So we see that the first measure is the reporting, as we got the reporting for 58%. Then it's about governance for 51%, followed by capital requirements for 42%, and others. So, Annika, does it reflect your local situation? Meaning, you have proportionality measures in Sweden regarding, reporting or governance?
In fact, we have done proportional measures in the Swedish legislation, in the implementation of Solvency II in the Swedish legislation. So we are concerned as a normal insurance company. So it's 100% everything.
Okay.
So the Swedish authorities don't see us as incorporated in the proportionality.
Okay. And Laurent, this result seems to corroborate the survey that FAMAS carried out among its members.
Yeah, absolutely. So, and just, well, I don't exactly know the proportion because I see 42% for capital requirement and solvency calculation. But clearly, what an outcome of our survey is that capital requirement and solvency calculation were the area where the proportionality was less applied, So very limited application of proportionality for that part. So that's clearly pillar one. Reporting was the highest one, so it seems that this is where you have more proportionality in the 9 countries we have surveyed. And governance, that was a mixed approach. So I would say it's in line with maybe capital requirement and solvency calculation a bit high compared to our survey, but it's proportionally correct.
Okay, so Anna, I will not ask you to comment, but I will instead give you the floor for your presentation. So it should come.
Yeah, I think I'll comment on the middle of the presentation. I'll try to go fast through the first slide, focus on the 2020 review, because we need to look to the future and to solve the things we can solve that were not solved at the beginning. So if we can go quickly for the first slide, an acknowledgement that in fact the Solvency II directive treats captives as other insurance companies, except otherwise specified, while recognizing the specific nature of the captives and the fact that they are in fact different companies in some sense due to the ownership and also to the purpose that they have. If we go to the next slide, I understand that you receive a more detailed package of slides. If you want to contact us as well later on, please do. So on this slide, we try to capture in the nutshell what is the simplification that we have today in the directive, and this is about limitations and exemptions of reporting, simplifications of TP, the MCR absolute floor, which is different for captives as well, and the number of simplified calculations of the capital requirement. You will see that the governance is not in this list, because proportionality in Solvency II is also about supervisory processes. So sometimes it's really how you supervise where you have to apply the principle of proportionality. And in relation to this, to the governance requirements, it would be difficult to reflect in the law simplifications or proportionality measures for captives or other companies, but needs to be reflected in the supervisory review process. Of course, that's the more difficult to harmonize, but that's where we need to work. If we can the next slide. I want to raise your attention to a supervisory statement that EIOPA published in March, which is going in the direction of what Laurent said about not having enough simplifications and the proportionality aspects on the SCR calculation. We have issued the supervisory statement trying to tackle that. We have arrived at the conclusion that, in fact, there were different supervisory approaches across Europe in relation to very immaterial submodules of in the calculation of the SCR. So if we are a company and you have some submodules which are really immaterial, and by immaterial we mean 1, 2, 3, 4, 5% of the basic SCR, you still have to calculate it every year, and sometimes with complex calculations. Sometimes complex calculations, others complex to arrive to the inputs of the calculations. So we have agreed and issued a supervisory statement where, if certain conditions are met, and if this, under a dialogue with the supervisor, companies may choose and may ask supervisors not to recalculate that certain submodules every year, but do it only on a 3-year basis. Of course, there's a number of conditions and criteria that we explain in the supervisory statement, but we believe this is a true example of what we mean of proportionality principle in the supervisory review process, and how not everything needs to be reflected in the level 1, level 2 law for us to be able to apply proportionality principle. If we can go to the next slide now. We are now then discussing the call for advice from the Commission. The Commission asked us to revise the reporting and disclosure package in general, if it is appropriate, if it is proportionate, and including all the issues that we need to address, volume, frequency, deadlines, in general, if it's proportionate. But as well, we need to address, and if we go to the next slide, the proportionality and the appropriateness of the thresholds of Article 4 itself. Article 4 defines the exclusions from the directive completely, so it defines if a company is covered by Solvency II or not, and we were asked to assess the appropriateness of these thresholds. The thresholds are not only size-based, they are also risk-based, so of course it can be considered types of companies. Also, we need to consider the possibility to waive certain requirements from the directive, and this should be applicable to all pillars. So for the first time, we were asked to assess if proportionality principle could be as well about exemptions. Until now, the general principle is that proportionality is not about exemptions, but applying in a different way, in a way that is proportionate to the companies. But now we are asked to actually assess if there's any requirements where we could completely exempt certain companies from the requirements. So if we go to the next slide, what are we doing now? We are preparing the first wave of consultation, which will begin mid-July, mid-October. We will have a public event 15th of July here at EIOPA, and in this first wave, we will consult on proposals from our part, general issues of supervisory reporting and public disclosure, where we will discuss proportionality. In fact, so how it's the application of Article 35, how can we see that further proportionality can be implemented in the reporting package. So this first wave is focusing on the reporting and disclosure. We go individually by template, trying to assess if it is fit for purpose, if it's not fit for purposes, or if it's a proportionality, and if you can improve the proportionality that is embedded already. We will consult as well on the solvency and financial condition report. Curiously enough, we have not heard about this today. It was more about reporting, but we know that public disclosure is also a concern for captives in particular. And finally, financial stability reporting. You will find in this consultation paper specific issues of captives. So we have addressed captives separately, of course, with the revisal of the package, but also with the thought on captives. We have used a lot the input we received from the industry. We have done a call for input at the end of last year, and we received specific input from captives companies. We have took that into account, and we'll see proposals on the area of both public disclosure and supervisory reporting addressing captives. I believe it's important to listen, to see our rationale, and then come back to concrete proposals how we can improve more, because we are really listening and we want to keep, we believe in Solvency II and in the principles of Solvency II. We truly believe that Solvency II should be applicable to all captives, but of course we need to make proportionality works, and that's what we need to get out of this 2020 review and improve moving forward. To finalize, I would like to say that we are also working, in the next slide, please, on supervisory convergence. Again, not everything needs to be reflected in the law, in level 1, level 2. We need to work on how supervisors across Europe supervise captives. We know that there are divergences. We know that there is some lack of consistency in the supervisory review process. That's why we identified in our supervisory convergence plan for 2019 that we are working on captives. We will discuss among ourselves the business model of captives. Are all the same? Are they different? How are they different? Exactly how to comply with the governance requirements that Annika referred, how it is done, taking into account the proportionality principle, the use of outsourcing, etc. Also take a look to the investment policies and asset management strategies, and in particular the cross-border issues. With Laurent's presentation, it was very clear that we really need to understand how these cross-border issues work and how they are being supervised across Europe. So we are taking a close look to the captives, proportionalities, and how they are supervised today. And this is the time to influence the future. So I will urge you all to see our consultation package in a couple of weeks.
Thank you very much, Anna, and you can count on FAMAS participation in the consultations coming up to definitely convey the feedback from the risk managers using captives. But Annika and Laurent, do you have any reactions or comments to Anna's presentation?
The first thing I want to confirm that you will definitely hear from us, because we have multiple feedback and ideas that we will share during the consultation. But the main, the positive aspect I would like to highlight is really that proportionality is really in discussion about how we can really optimize it, and it's not only for captives. And we always talk about captives because we are in a forma representing the risk management industry. But if you also think about small or less complex insurance companies that may also have difficulties in coping with that because of their size, and by the end they are also adding competition in the market and allowing the end customer to have access to better products. because they're very specialized. So it's really not only about captive proportionalities, of course, for the other insurance companies that may struggle with that. So I'm really happy to hear that it's now really addressed in a comprehensive way. So I believe FAMAS will be happy to cooperate and submit ideas during the consultation phase.
Annika, do you have anything to add?
No, I just to add, I agree with Laurent, and I'm very happy that EIOPA now is putting up the functionality of captives on the agenda. And I hope you really be able to supervise the local financial authorities in Sweden to get a better proportionality. We have a lot of captives in Sweden, so I really hope that.
Okay.
And just maybe if I may, to come back to what Anna was saying about proportionality, that it's difficult to define. I remember years ago in a discussion, someone was saying that you EIOPA or the supervisor, define proportionality, but actually if you define it, you lose it. So it's that's the difficult balance to find between how to have that convergence without defining it in a strict way, because then you lose proportionality, because then it's not for the local supervisor to adapt its approach to the size and complexity of the insurance company.
Let me fully agree with what you just said, Laurent. I think it's very dangerous to try to define proportionality in a rule-based. The moment you do it, you lose it. That's exactly what you say, and I just want to support that statement. Of course, that it requires more work from a convergence perspective, from a EIOPA perspective, working with our members. It's not so easy, but it's much better, and it's for certain more risk-based.
Okay, thank you. So it's time for the Q. Polling questions on how captives can be used innovatively. So do you think that captives are fit for acting as risk incubators, covering new risks like cyber or climate change? Okay, so we now see the results. So 81% do agree with this statement. Annika, would you like to react?
I think a captive can act as a risk incubator in that sense that they can, for the big group, can design a program that cover new risks. But it's also up to the owner if they want to take the risk in the captive or not. So that's, in fact, it's a discussion between the owner and the captive. But I think we as a captive can design new programs and put it out in the market and get a response on that. So in one way, yes.
Okay. Laurent, do you share Annika's views?
Yeah, not really. I'm again, I will be the bad guy. Yeah? It's a trap. Huh? So I do not agree. That's my view. I mean, my view is that you don't need a captive to do that. And I really don't like the idea of a captive as being a risk incubator or covering new risks, except if you support a risk transfer program. So my point is always to say, if you use a captive to design a new product, insurance product that is 100% retained by the captive, it's financially inefficient because you have frictional costs, because you could have a cost of economic capital, and it's only about collecting data or looking at your claims. I mean, you don't need an insurance vehicle to do that. It's a management process. So for me, the captive is always supporting and helping to optimize a risk transfer solution, except if you just need an insurance paper, and then that's something else. But so no, I would be in the 19% saying no. You know, that's not for me the best tool for acting as a risk incubator.
Okay. Okay, good. So we have received from the audience some questions. I see that we've got 5 minutes left. So the first one is, can a credit rating help a captive to reduce its fronting insurer's fees?
Definitely
So,
yes.
Laurent?
Depending on your rating, of course. But yes, it can help you to reduce either the requirement or the cost if you are able to remove the collateral requirement. So yeah, theoretically yes. And now it depends on the insurance carrier. Some are, you know, accept to remove the collateral requirement. Some are just saying it doesn't really matter because it's a captive. So it really depends on the specific of the situation. But theoretically, yes, it could help.
Okay. Okay. And then we have a question which is quite tricky. How to choose a captive domicile?
If you like to travel or not, huh?
Okay, so
That's not an issue.
No, but it's once again, you know, I was talking about the risk profile. It's also about the profile of your company. You have multiple aspects to select a domicile. The first one is, of course, what is the structure of your company? Where are you located? I mean, if you are a Brazilian company, maybe you are not going to Singapore, I don't know. So that's the first aspect. The second one is what you want to do with your captive. What is your strategy? I mean, do you need, you know, a specific workforce? Do you have is it a classical way of using a captive, or are you going to do, you know, new risk or supporting new program, and you would need specific skills that you don't find in all countries? So some are more specialized in some kind of risk. The structure of your captive, you know, if you think about Luxembourg, that's typically a reinsurance domicile, while Sweden is more about insurance companies, I believe, insurance captives. So it's also dependent on, if you want to run an insurance captive, you should not select Luxembourg, that will not work. So you have multiple aspects that you have. So it's really a tailor-made solution, and you have to address all of these. So there is not one answer. Saying it really depends on what you want to do and your profile.
Mm-hmm. Okay. And there is a question for you, Anna. How to reconcile a diverging interest of member states on supervising captives? This is, of course, something that you've mentioned is not an easy task, an easy job to do. But can you elaborate on how you're doing it?
Yes, so actually the work is just starting. It was identified in the Supervisory Convergence Plan on 2019, and we are just starting. The way we usually, I mean, it's not the first time we are finding divergent supervisory practices, and we are all working together. The first step is that we set up a group. We discuss between us what are the good practices that we find among us, where we find differences and why the differences exist. Sometimes there are reasons for the differences, in others not so much. It's more a cultural difference. And then once we have identified the issue, we study between ourselves what is the best tool to address it. And sometimes the tool is a public one, like the supervisory step I referred to address the issue of proportionality on the SCR. In other cases, it's not private, it's public, and we develop, for instance, a chapter on our handbook to address a certain issue and try to harmonize the supervisory practices in that way. Now, in addition, we have the advantage of having the 2020 review, and of course that to change level 1 or level 2 is an additional tool we have at our disposal at this moment, and that the group will consider if needed after the discussion. So we first start by identifying the issues, and then we decide the correct tool to solve it.
Okay, thank you very much, Anna. And we have a last question, and I will address it to Annika because you mentioned this point. What are the qualities of a good captive board?
Yes. on my wish list is that there is have an experience of insurance market and the insurance industry, that you have some experience of reinsurance, that you knew the basic how the basics in the insurance market works. But it's also very important that you have a board that also understand the whole business of the whole group, so they know, so they can handle the risk and the complexity. So I think it's quite challenging to put together a good board.
Yeah, Laurent, do you have any tips to share?
Jesus, I don't have all tips and tricks you need. Huh? No, but that's correct. It's always it's difficult, because if you think about, and if we talk about a captive, we talk about the companies that is not active in insurance. So finding within your colleagues someone having a good insurance or reinsurance background and having an understanding of actuarial stuff, risk management, that's not easy. So I would say it's really about having a team that can fit with someone from legal, maybe someone from consolidation, and if you can find someone having a good background, that's fantastic. But it's really about thinking, and that's a bit what Solvency II is asking, and I believe it's a very relevant rule, is really to have the board should be fit to the task, but as a team. It's not about having someone knowing everything. It's really a board of directors that all together should be able to address, the actuarial, technical, legal, managerial stuff within the captive.
Okay. Well, thank you very much. Well, this webinar has come to an end. So I just wanted to inform the audience that if they would like to further discuss this topic, we will hold a workshop at the FERMA Forum on the 19th of November on the future of the captive model. And the registrations are open. It's free for risk managers for attending. You will all receive the replay of the webcast and the slides within 24 hours. Those of you who are REMAP certified can log 2 CPD points for attending this webinar. And last but not least, I would like to thank our 3 speakers. Thank you very much for being with us today. Thank you to the audience for joining this webinar, and keep tuned for the next webinar, which will take place in September. Have a great day.
Thank you very much. Bye. Goodbye.
Bye.
Bye.